This is an interview with Professor Charles Calomiris, an economist who spent his career studying banking crisis, financial regulation, and the policy mistakes that make systems fragile. He's taught at Columbia Business School, served as chief economist at the Office of the Comptroller of the Currency, and co-authored Fragile by Design, a book about how politics shapes banking stability. You can read more about Charles on our website, 6degrees.blog, or on our Instagram page, 6degreesaway. Thank you and enjoy the interview.
Drawing on your upbringing in Washington, D.C., and your father's work as a banker and community leader, how did those early environments and conversations guide your decision to study banking history and shape the questions you've pursued?
That's a great question. And I can see that you've done a little bit of research thinking about me, so I appreciate that too. Well, you started off with a bang, my friend, because everything that I chose to do, professionally, intellectually, is definitely influenced heavily by my father. My father lost his father when he was 16 and had, these were the days where there wasn't much of a social safety net, 1936. And he had siblings too in the family, some younger than him. And he faced a really difficult decision because he wanted to finish high school. His dream was to go to law school eventually, but he had to drop out of high school. So he left high school in, I think, his junior year, and he's had to just basically find a way to make enough money so that everybody could survive. And there was some insurance money that his mother had. She gave it to him and he invested it. And from what I understand from him, he sort of saw some daylight in terms of the rooming house business, so the rooming houses are sort of, you might have for example, a 4-family flat, which was a standard kind of piece of real estate in those days. So it might be a building with 4 apartments. And so he would be the janitor, the engineer, the gardener, everything else. Anyway, so he was really a real estate developer, but also a kind of philosopher, and was very interested in the economy. And back then, too, another thing to mention is when I was 17, that's 1974, the country was going through a really difficult time in terms of inflation. And we had one of the worst chairs of the Federal Reserve that we've ever had. By the way, our current one is, I think, a close second. But this one was Arthur Burns. And Arthur Burns, I remember my father being in the real estate business was so affected by what the Federal Reserve was doing and the level of interest rates. A lot of other people were being driven out of business. And so I realized right then and there at age about 16, 17, not just I idolized my father because he was such a hard worker, such a smart person, such a philosophical person, and so devoted to his family and to God too, by the way. And I idolized him, but then what I realized was, oh, wow, everything could go. A lot of his friends were going bust because of the escalation of interest rates. And as you may know, interest rates really kept going up. And in 1981, interest rates were really high. It really took Paul Volcker's fight against inflation took a long time to bring long-term interest rates down. So it's very clear to me that the reason I got interested in banking and monetary economics and finance more generally was related to that crisis that so many people were experiencing. And you see businesses that people had devoted decades to disappearing, in a snap of the finger. And I've spent a lot of time studying financial crises and monetary economics, and especially policy mistakes, and also flaws in systems. I think that my whole orientation toward it was probably very deeply shaped by the 1970s and by being around businesses that were really struggling.
To pivot from background to training, how did your education at Yale for the BA and at Stanford for your PhD, including your dissertation on the historical theory of money and mentorship, for sorry, I'm a little sick, so please
It's okay. No
forgive me
problem.
for any pronunciation mistakes or
You get
caution.
extra credit.
From economic historian Paul David, shape the analytical lenses you apply to banking and financial stability.
Those were all big influences, as you're saying it. So I had a very privileged upbringing. My parents, we lived in a great neighborhood. We had a beautiful house, wonderful family and friends. I was just so privileged, and I was able to go to a great school, a private Quaker school in Washington called Sidwell Friends, and that really nurtured my intellectual curiosity. And then when I was lucky enough to do well there and then be able to get into Yale, Yale was really the place where I felt more naturally at home than any place I've ever been. I'm not sure I would feel that way today because things have changed and become politicized. But back then, there was just a sense of duty to learning. I can't really explain it any other way. That my friends and I really, we liked having fun. Okay, we did. But it was no question why we were there. And you didn't get kudos from at least my circle of friends for going out drinking. You got kudos for really coming up with some great ideas, getting, and it wasn't kind of nerdy stuff. It was really more like creative breadth and depth of thinking that we all had a sense of humor. We enjoyed talking to each other. It was such a lively environment. And I have to say, even going to graduate school, even though there it was different because it was much deeper understanding of economics, much closer relationships to your colleagues and to your faculty. And yes, you can get, Paul David was a huge influence on me in the way he thought about how to think with history. And, he liked to talk about the concept of path dependence. But what path dependence really means is that you have to qualify your normal kind of mechanical causal thinking by understanding how historical context tends to create persistence. And that idea that preconditions change things so that you can't just analyze a problem outside of historical context, and you have to modify your causal reasoning to take into account the influence of historical features. I thought this was just, first of all, that was mind-blowing because it meant that the whole way that economists approach things, it's a lot harder. It's more, has to give shape to a narrative. And it just was wonderful. But I just want to say, even though all that's true, there was no experience like being a Yale undergraduate for me, because in those days, because there was really a commitment to open inquiry, civil discourse. People were so different around me. And I'm not talking about their skin color or the region that they came from. They were different in those respects too. But what was really different was they thought different. And people really respected each other. The world has become so polarized. But when I think back at Yale in the 1970s, people just really relished open inquiry and courageous kind of thinking. So Stanford was great. I learned a lot of economics. I learned about very complicated ideas. And also I just got modeled. Some people just modeled for me what it means to be an intellectual. I'd seen some of that at Yale because I'd had some great professors. My first money and banking course was James Tobin, Nobel laureate, really the father in many ways of the American research in money and banking, one of it, certainly. But as much as, all that stuff mattered at Stanford, I also remember Ken Arrow, who was a famous micro theorist. And he was a terrible lecturer. I mean, in a way, he would kind of ramble sometimes. He would go off in his thoughts a little bit. Sometimes he would think one time he thought he saw a way to prove something faster. He spent a day and a half of lectures down a rabbit hole that turned out not to work. And so everybody, remember, we're having pages of notes. Those were the days when you're taking pages of notes. And then and he says, oh no, it's not going to work. That's like 3 hours of detailed notes later. Okay, what did I learn from that? What I learned from that was that his mind was always active. He was always in the moment of trying to discover, of trying to learn, of trying to understand, and was connected to us. He didn't just come in with, it was just a style of being more than a style of teaching. And what was he being? He was being an intellectual, committed to trying to understand things. So those influences, Paul David, Ken Arrow, there were lots of others, and also at Yale, were really a big deal for me. And it took me from kind of interest and dedication in learning about the world, coming from growing up around my father, to a different kind of thing, which was seeing what it would mean to be a professional intellectual. And actually, when I finished Yale and I told my family that I wanted to go become a professor, they said, oh, well, you're going to go study economics. And they thought, that's good. It wasn't what they wanted for me. They kind of were thinking I should go to law school, because that's, it's a Greek American family, a professional doctor or lawyer sounds real good to them. They said, okay, well, economics, that sounds practical. And then it became clear to them that I was interested in becoming a professor. And that didn't make sense to them at all. Like, what a waste. What are you doing? Are you kidding me? And I kind of understand. Sometimes I think they're right, by the way. Sometimes I think it was kind of a wasted life so far, because, professors, there's a vanity of thinking you're going to influence people's thinking, or, come up with a good idea and then it will matter. And you realize that there's a lot of sort of, let's just say, stability in the world. Some of it's bad stability, where some new ideas can really take off, but there's some reasons, particularly political reasons, when you're studying economics, that you start realizing that things that you'd like to see fixed aren't going to be fixed, and people don't learn lessons very well. Right now, and I don't want to, get into partisan bickering or anything, but just to say, it's very disappointing to see people making the same mistakes, our government making some of the same mistakes in terms of tariff policy, in terms of banking regulation policy, making some of the mistakes that are just very well known. So then you kind of, as you get a little older and you start seeing that, you can definitely see how becoming a professor and doing work on research in some sense can feel like it's a waste of time. But at the same time, I guess I'll conclude here and say, what all those influences really teach you, especially people like Arrow and Paul David, is it's really about the way they are being. It's about the process of doing research, of trying to get it right. By the way, I also write music, and it's not really a very different activity from doing economic research in my mind, because I believe that there's such a thing as truth in music, and there's such a thing as truth in research. And I just my whole life been lucky enough to be around people who just modeled for me the idea that you could devote your life, apart from your friendships and your family relationships, which of course should matter more, but you can devote your professional life to just truth. There's the, and beauty, truth and beauty are two sides of the same coin as far as I'm concerned. And that's what intellectual life really brings to you. So, for those of you who are listening to this, it can really be a beautiful life to just try to learn things and make original contributions to things. And even if the world of government policy and even your colleagues what they believe or don't believe, even if that doesn't always conform to what you'd like it to be. Sometimes, I guess, just the beauty of it is kind of enough.
When you say there's such a thing as truth in music, what exactly do you mean by that?
Well, actually, it's more obvious in music than it is in economic research.
Mm-hmm.
If I play two notes that are dissonant, it's not like I need to prove that they're dissonant. And I play two notes that are more harmonizing and making a beautiful sound. I don't really have to. You may sometimes want to create tension or difficulty in sound, but the point is that's subjective. If I tell you, if I play two notes and I say, what do you think? Is this a sound about harmony or is it a sound about dissonance? Consonance or dissonance? Well, that's just is. That's not, you're not going to say one thing, I'm going to say another. So music is, founded in vibrations, and those vibrations have a logic, a mathematics to them. That means that music has a truth to it. And you know that the ancient philosophers talked about this quite a bit, about music as kind of example is the wrong word, but let's just say an embodiment of the truth of the world. That is, that the world is something that can be understood and studied, as Aristotle liked to think about it. Let's say that, and for Plato and Aristotle, just for example, music was hugely valuable, and they weren't valuing things that they didn't think were important or were centrally related to the investigation of truth. And that's why music was considered as part of classical education. Music was an essential part of classical education because because there is a truth to it, but also because of the way it affects us and the fact that it's part of the physical world we experience. And so as somebody who, I probably spend more time nowadays on music than any other thing, I'm still doing research full time, but in terms of leisure, and not just leisure, but also productions that I do. Yeah, I would tell you young people, get with it. If you're not, and the thing is, listening to music's a good first step. But if you're not around the physical creation of music, not everybody can physically create music. I understand that. There's some talent issues. But be around, if you're around people, friends who make music, if you go to live performances, the physical fact of the making of music in proximity to a human being is something that there is nothing else like. Other art forms, you might see a painting, but you don't feel, the painting doesn't accost you. The painting doesn't touch you. People say, oh, that work touched me. What they mean is, I put the effort in to go to that painting with my eyes and try to understand it. But if I'm sitting in a room, the music is hitting me. It's coming at me. And so it's a different kind of immediacy of physicality. So yeah, I know that's not the topic we're really dwelling on, but I do want to say I think that music is a window to the idea of truth and reality, and beyond that, to spiritual truths too, not just physical truths. So yeah, I strongly recommend to anyone interested in understanding things that they take music in as part of that.
Mm-hmm. And to move from scholarship to impact, having worked at Columbia Business School as a professor and at the Hoover Institution as a visiting fellow, what did you learn about turning rigorous academic research into policy that regulators and legislators can actually use?
Well, I was also chief economist at the Office of the Comptroller of the Currency, and I was a consultant to various government agencies all around the world, not just in the U.S. I worked in the government's agencies in countries like Argentina, Brazil, Mexico, El Salvador, Colombia, Japan. I was also a member of a government body in the European Union. I ran a couple programs in some other countries too, in Asia and Africa. So I've been around quite a bit to see about how ideas can translate into policy, which is what you're asking about. So I've had a pretty interesting experience there. I've been very lucky, and it's very enjoyable to try to sit down with people, especially if they have a window of opportunity. And I want to emphasize this. For most of human history in most countries, we're in some kind of political equilibrium, by which I mean it's very hard to change things. There's a lot of stasis coming from having a good idea doesn't change the political interests that are aligned in a certain way to preserve a certain set of policies. And I would say that for the most part, ideas are a necessary to make an improvement. Ideas are a necessary, but not a sufficient condition. And for most of the time, they really aren't going to make the difference. But you have to have them. So my friend and kind of a mentor, Alan Meltzer, the late Alan Meltzer, whenever I would get a little discouraged, would say to me, almost like a soldier kind of thing, buck up. Our job is to create ideas and put them on a shelf, ideas that make sense. And when society is ready to listen to those ideas, they're sitting there on the shelf. So I think this is a really important way to think, because my book, Fragile by Design, with Steve Haber, we talked about how ideas by themselves don't really shape things. It's ideas within political systems, and political systems often reject good ideas on purpose. In fact, that happens, 99% of the time. I'll make up a statistic. But what Alan Meltzer taught me was not to get discouraged by that, because I can point to countries that go through transitions. For example, Brazil in the 1990s, under the leadership of Enrique Cardoso, there were lots of things that you would have said, because I did part of my dissertation, PhD dissertation on Brazil. You would have said, from being a student of Brazilian history, let's say as of 1990, you would have just said, it's hopeless. It's hopeless. It was, the country with the highest average inflation rate in the world for the previous 200 years, just corrupt, horrible, military dictatorship, they just had gotten rid of. Things were just terrible. They didn't even have a functioning banking system. It was just a complete mess. And yet, along comes somebody who has an idea about how to change the way the political coalitions function, and sees the possibility for what I'm going to I'll follow my friend Lee Alston in calling real leadership, where what real leadership means is you see this bad equilibrium that you're in with the political forces creating the stasis, and you imagine a better equilibrium that is in some sense physically feasible. And then here's where leadership really gets important. You can articulate to other people that you're in a bad equilibrium, but that it would be possible to move to a good one. And then tell them a convincing story about how that could be done, and then execute it. That is unbelievable. That happens maybe for a country every 20, 30 years in the world. It's not something that happens every year. That kind of transition, let's call it transition from a bad but very stable equilibrium to a good, stable equilibrium, that happens very rarely. But I do, as a historian, I can tell you it does happen. Another example would be Chile in the 1980s, or Hong Kong in the 1970s. So we can find examples of countries that are kind of basket cases that through some constellation of the stars and the emergence of some leadership vision can, and I'm not talking about like, strongman leadership. I'm talking about the kinds of things that Cardoso did. Whereas, so, Cardoso, let me put it quickly. He basically said to people, okay, he's a professor, going to run for office. I'm going to be the president. I want to be the president. He said, first of all, anyone who tells you that in 4 or 5 years they're going to make the country rich or they're going to end poverty is just lying to you. And what we need to do is we need to prioritize that we're going to improve poverty. And the way we're going to do that is by really creating opportunity and inclusion for poor people in our country. But the way that takes time to do, and it will only be successful if when we prioritize that goal, we also prioritize not just spending huge amounts of money to create fiscal crises that destroy the government's ability to have a long-term focus. And so those were the two legs he was standing on. We need to be honest, not to think that we're just going to throw money at problems, give you money, and then you'll feel a little better. You'll reelect me. Yeah. No, that's not it. It's going to be, we make a commitment to something that makes sense in the long term, and we're careful about our fiscal spending so that we as a society will be stable enough to get there. Now, that is kind of amazing. I can say it, and I still can't see how he could possibly get people to go along with it. But part of it was that Brazil had been experiencing a hyperinflation. And so people were very cynical about government promises, and they knew that government's overspending was, very destructive to their lives. And to give you an example, one of the programs that Cardoso set up was a program that paid mothers to send their kids to school, because a lot of kids were truant. A lot of kids were not going to school. They would just hang out to try to, wash windshields at cars at traffic lights. And when you went to Brazil, you saw that all the time, kids not in school. And somehow he figured, well, if I pay mothers to put their kids in school, then the mothers will see that they're better off putting their kid in school than having their kid wash the windshields of the cars. And of course, the mother wants her kid to do well too. And so think how smart that was. And then at the same time saying, and no, I'm not going to do a bunch of giveaway programs that we can't afford. As much as I'd like to, immediately make all of you rich, that's just not feasible. So that's real leadership. It's not populist leadership, which is what we're experiencing too much of right now in the US. It's not telling people what they want to hear or telling them things that are charismatic. Charisma is a combination of empathy and boldness. And so we know that we've had some charismatic leaders. I don't want to pick on any of them because I'm not negative overall on any of them. I'm just trying to say the thing that was so interesting about Cardoso is he was kind of empathetic and bold, but not populist, not telling people the easy thing so that he could be popular over the next year or two, telling them the hard thing. And I think that time has proven that this was a real transformation in Brazil. I know they're going through some hard times. I could go into that, but it's not really important. The important thing is this is where the excitement is. So when I was advising countries, whether it was Mexico or El Salvador, or Argentina, I was working there off and on for months or years on end, and really trying to help them figure out some knotty problems. And what made that attractive to me was that I knew they were in a window of real opportunity for thinking. So that's not generally the case. Generally, thinking is not really rewarded. Like right now, I try to influence some thinking having to do with bank regulation. using logic and facts. And we have several hundred banks that are probably insolvent right now in the US that the Biden and Trump administrations really didn't do anything about and don't seem very likely to want to do much about. Because if you shut down banks, you reduce credit, there's a negative short-term effect. So like a lot of policy problems, not all of them, but a lot of them come down to incentives to be myopic, like what I was describing in Brazil, how his vision was a long-term vision. And right now, if you wanted to know why are we not doing more to improve the functioning of the banking system and stabilize it, the answer is because the short-term incentive that politicians have is to goose the credit of the banking system. And you don't get banks to issue more credit when you start leaning on them to try to strengthen their balance sheet. It goes the opposite direction. So, that's a long-winded answer to your question. I've had a mixed experience. I was smart enough to realize that you waste your time if you don't go to countries that themselves are looking for this kind of long-term logic and fact-based policy advocacy. And I've been lucky enough to have those kinds of connections and relationships and be able to point to some good outcomes that came from that. Sometimes they were reversed. Sometimes they were only done partially based on the idea. But I did enjoy the process. I certainly learned a lot from it. I'll tell you one story, gives you a little bit of a sense of that learning process and the way political constraints matter. In November 1995, this is right after the Mexican financial crisis, I was on a World Bank team as an advisor to try to help them improve the structure of their financial system. And so I was familiar with the literature up to that point. I went down, we're meeting with a bunch of people in Mexico, and I said, well, we can really make a big improvement here if we improve the legal system by allowing creditors to exercise their collateral rights more effectively. Because then you'll lend more to people if you know that if they don't pay you back, you can seize the capital, right? And so if you don't have that, then you're not going to lend, and then people aren't going to have any money to invest. So I said, we have this experience in the US and lots of other countries with uniform commercial code, which I could explain, or with other kinds of laws. And I noticed Mexico doesn't have a very effective legal system for enforcing creditors' rights. So let's talk about incorporating those changes. Something happened that I didn't expect, that I'd never experienced as a professor up to that point. Everyone in the room burst out laughing. I know I'm a funny guy, but that wasn't a funny recommendation. So why did they burst out laughing? They burst out laughing because, well, then as they collected themselves, one person said, do you think that we aren't aware of those institutions that you're talking about, those improvements that are to the law? Do you think we don't know about them? And I said, well, you don't have them. They said, that's because our bankers don't want them. So I said, okay, now I'm really confused. The main beneficiaries of improving the laws to allow creditors to collect loans are the bankers. So how can it be that the bankers don't want to see improvements in laws that allow them to collect their loans? And then, of course, they explained to me that the way it worked in Mexico at that time was that the grupos, which were conglomerates, industrial conglomerates, they tended to control banks. The investors, the stockholders in those conglomerates also controlled a bank. And the bank lent to the conglomerate. And the conglomerate, because it had a coincidence of ownership between the bank and the conglomerate, well, you knew you were going to get your money back from yourself, right? Now, what happens to their situation when you improve the laws? Well, that means banks can start lending to other people. They can start making what we call arm's length credit. Not just lend to the person who runs their life, but lend to other people, because that's when you need the law. You need the law to get money back from someone other than yourself, right? But then what happens when you pass the law? There's less money to be lent to the conglomerates. They have more competition because other people now have a chance to pay their money back, can be considered as good risks to pay their money back. And so this was explained to me. The bankers don't want a legal system to improve that makes them have to compete more in their role as the people running the conglomerates. Mm-hmm. And then I realized, as I was getting to know people in the 1990s in the World Bank, that this was a problem that was actually fairly common. And then when I wrote with Steve Haber, Fragile by Design, that experience and similar kinds of experiences had a big effect on how we thought about the role that politics plays in shaping what's feasible in policy. And so I had a lot of those experiences, and sometimes they taught me great things about economics, sometimes they taught me great things about human nature, and sometimes they taught me great things about political equilibrium.
To shift towards incentives and safety nets, your work links deposit insurance and other safety nets to increased risk taking. So, how should deposit insurance be structured and supervised to limit moral hazard while still protecting depositors and preserving confidence in the system?
So, yeah, I mean, that of course is a very big question. I've devoted many years and scores of articles I've written on this topic, but I think I can answer it for you. In the absence of deposit insurance, the way banks behave is that they manage risk. Because if bankers are scared that they'll lose their sources of funding, especially if those sources of funding are short term, it makes the banker want to do two things: to manage risk and to be able to communicate to people outside the bank in a credible way that they're managing their risk. So don't be worried. Don't get afraid that you're going to lose your money, Keon. Leave it in the bank. Let me show you what I'm doing. Okay. Now, what we call that is market discipline. You're my depositor, and we have a market relationship, and I know you're going to discipline me, that if I do crazy things and you see them, you're going to take your money out. So I'll try, first of all, not to do crazy things, and secondly, to show you that I'm not doing crazy things. Now, what does deposit insurance do? It makes you stop worrying about what I do, which means you're not disciplining my behavior anymore. I only need to worry about the government official. Because when I have deposit insurance, then the government officials are now regulating me, because they know that having given me deposit insurance, I'm in a position where market discipline is removed. And we have to substitute regulatory and supervisory discipline for the, and now absent market discipline. Now that's hard to do. How do you do it credibly? So what we mean by regulatory discipline is we adopt standards that should be similar to what the market standards would be. We adopt standards that say, you can't just invest in the riskiest assets. You can't lever yourself to the hilt and have very, very little what we call equity cushion on the liability side of your balance sheet. And you got to maintain liquidity of your position too, so that you have enough cash to be able to transact. Now, those are pretty simple regulatory standards. Simple to say, not so simple to do. And before I tell you how to do that, I'm going to go into the next topic, which is supervisory standards. The reason we have regulation and supervision, we can think of them as belt and suspenders. That if the regulatory standards were perfect, we just rely on those. But what supervision does is it looks beyond just regulatory compliance. So first, the supervisor has to ascertain whether you are compliant in the regulation. But then, identifying weak spots that maybe aren't addressed by the regulatory standards. so that an intervention can be justified simply by the sort of supervisory observation that goes beyond just the things that you're required to do that are codified in some regulatory law. Now, to do this effectively, it shouldn't surprise you that what you have to do is you have to kind of mimic the way markets measure risk and the way markets think about punishing you for violating your risk. Because we know that the market does this pretty well. So when I was at the OCC, the Office of the Comptroller of the Currency, we had a project in which more than 30 PhD economists were involved in basically figuring out how to do this correctly. And to make a long story short, the point is to use robust criteria that measure, they're close to capturing the default risk of the bank. So the regulatory standards have to be meaningful. So for example, looking at book value of equity is not a very good guide. You have to have a way to try to either measure or simulate what you think the true economic value of equity is. When I say equity, I mean, so let's say the value of the stock in Citibank, it has a book value, which is just the difference between the face value or we'll just say the accounting treatment value of assets minus debt, right? Then that's equity and book value. But what if you're lying about your loan values, but the market knows that your loans are actually not worth as much as what you're carrying them for in your book? Or what if you're wasting resources running lines of business that aren't profitable, that might not even show up on your balance sheet, that just are fee generating, that don't have any dedicated set of assets? So those are actually very real problems. That's not hypothetical. Banks' book values are not reliable because of those two things, those two kinds of influences. And so we do have ways of designing tools that measure. That improves the regulatory standards. And similarly, we also have tools that can create red flags, that can say from the supervisor, okay, I'm watching all those regulatory standards, and as far as I can tell, your cash ratio, your equity ratio, all these things I'm monitoring seem fine. But I just got a red flag. What would be a red flag? I'm monitoring something about the actual operations of your bank that's making me worry. And that's where a supervisor who is awake can make a difference. Let's look at SVB, Silicon Valley Bank. In 2023, long before, months before that bank had a failure, it had experienced an outflow of some uninsured deposits. The supervisors, suddenly, and it was reported on its balance sheet. So let's say, I don't know, it might have been, if I'm trying to remember, I could be getting it wrong, about $20 billion flowed out suddenly. So what did the bank do? It went to the Federal Home Loan Bank and borrowed that money from this quasi-governmental agency. What should have happened was that the regulators said, wait a minute, why did that money flow out? Your whole accounting treatment of yourself as being immune to liquidity risk, this so-called hold till maturity accounting, is obviously not true, because you just experienced a major liquidity event related to a solvency concern. You need to change your accounting. You need to immediately raise new capital. If they had done that months before, the bank would have been able to raise the capital to go to its shareholders or go to the market and raise new equity to preserve its stability. Instead, what the regulators did was they pretended that the pretend bookkeeping of so-called hold to maturity accounting, which says you can overvalue your bond holdings if you can tell a story about how you're not subject to withdrawal risk, that was fine. But of course it wasn't fine. And in fact, the government was complicit because it was lending money to fill the gap to prevent the bank from having to address the withdrawal that it experienced. So that's a case of clear supervisory failure. Michael Barr at the Federal Reserve, the vice chairman for bank regulation supervision, he should have been fired. Also, the president of the San Francisco Federal Reserve Bank, who was in charge of SVB, she should have been fired. There were no consequences. The head of supervision at the San Francisco Fed should have been fired. No. Nobody was held accountable. They all tried to write reports saying, oh, terrible mistake. But it wasn't just a bad luck outcome. It was a result of a purposely ineffectual set of regulatory standards that treated, first of all, that treated the assets as worth more than they were on purpose, knowingly, and that didn't try to then, when they saw supervisory evidence that their behavior and the operations of the bank were changing in a bad way, didn't intervene. So I just want to really emphasize this. The biggest mistakes are fixable. When I was a chief economist at the OCC, we developed very reliable tools for red flags of bank problems of our member banks. And we also developed regulatory and supervisory standards. You could call them a different set of capital and reserve standards, first of all, grounded in economic reality, not just book values. And secondly, supervisory, what I'll call a dashboard, a set of indicators that you're monitoring. And if you see one of those go off, it's a red flag. And then you say, okay, notwithstanding the fact that my regulatory standard seems to be met, I need to dig deeper and I need to do it now. This is not that hard. It's just that the political will to do it isn't there. So I'm sorry to say this, but supervisors, it's not their money that's lost. They're government employees. If their supervisors say to them, well, don't make trouble for Citibank. By the way, that's not just hypothetical, okay? Citibank's a very big, a very unstable and weak, perpetually so, and also politically influential bank. And so, yeah, of course, Citibank should have had its, been taken down a notch and forced to rebuild its equity and forced to limit some of its risk. And that should have happened several times in its history when it didn't happen. Citibank has gone bust several times and it's still alive. Why? Well, it's too big to fail, people say. I don't believe that. I think that Citibank should have been wound down after each of its problems because it was a sick organization and it still is. So I think that the hardest thing for young people to really believe, but trust me, I have been there. I've spent my life interacting with the regulatory world of banking. Most of the problems are fixable, but we simply choose because of politics not to fix them. And it's partly an incentive problem. But I want to keep going back to politics because, yeah, I understand the incentive problem, but I can fix the incentive problem if I have the political will to do it. By the way, the Financial Economists Roundtable released in 2024 a lengthy statement on the failures of the banks in 2023 and on how to fix the regulatory and supervisory framework. I was the chair of the drafting committee that produced that report for the Financial Economists Roundtable. And I would point all of your listeners to that 2024 report from the Financial Economists Roundtable, FER, sometimes it goes by, as a guide to how economists think about public policy in this area. But I just also want to emphasize, none of the ideas that are discussed there, despite the fact that people who are specialists in banking and bank regulatory policy coming out of universities tend to agree that those ideas make sense. None of them is being implemented anywhere. Regulators and supervisors seem to be pretty immune from criticism coming from the academic world.
To introduce regulatory philosophy, you've criticized Dodd-Frank as entrenching too big to fail in favor of simpler incentive-based rules. So why would requirements like roughly 20% cash reserves and a floor of uninsured subordinate debt
Yeah.
produce safer banks than complex regulatory frameworks?
Exactly. Yeah. Do you want me to explain that?
Yeah, so why? Why would it?
So let me point to two things. And I think that um, this is pretty readily apparent. So the reason why we get trapped into the too big to fail argument is that when these large banks get into trouble, we worry, and it's not a completely foolish thing to worry. We worry that if we try to liquidate them, that will cause knock-on effects throughout the financial system, as sort of like a game of musical chairs. Oh, they start liquidating assets. Maybe that drives the value of certain assets down in the economy. They're so big, maybe they have a systematic effect. They reduce their supply of credit. How do we make that up for that? Who's going to make up for all the loss that comes from winding down a very large bank's balance sheet? These are not silly concerns. They're real concerns. Now, we can think of that. So that's our problem. That when these banks fail, the day that they fail, we find it very unpleasant to think about winding them down. So now there are two approaches that are going to be suggested to you. One is going to be living wills. Okay, what is living wills? Living wills is going to be this approach that says, don't worry, we'll come up with a plan. The bank and the supervisors will have to approve it. The bank will just write down a plan about how, if it fails, it's going to be liquidated in an orderly way that's not going to cause any problems. Okay, now, most economists look at that and say, how do we know that plan's going to work? And oh, by the way, you're relying on other banks buying certain classes of assets from the bank that fails. But what if there's a common shock that's affecting two or three of these too big to fail banks at the same time? Who are they going to go to be bought out? And if they do get bought out, at the moment we have like 4 huge banks. Well, how do we feel about having 3 if one acquires the other? That's not a very good solution. So the point is, you can come up with a solution that can sound good to an unsophisticated person, that politicians and regulators can say, we're stabilizing, we'll never have too big to fail again because we have living wills. What a load of bunk. Very complicated exercise, or I'll give you another exercise, stress testing. Well, it sounds good. We're going to come up with a scenario. It's not a bad idea. And we're going to tell the bank, okay, imagine that this happens. Are you going to survive? That's a stress test. But is the scenario thoughtful? Have you thought about how the scenario actually unfolds and what effect it has on the bank's assets and cash flows? And the answer is no. The scenarios are not credible. When they were established in them, I said, why don't you create an independent team to criticize the scenarios? Of course, they would never do that. So the problem is these things sound formally very good, but they're not credible. They're not credible as ideas. What is credible? Establishing some kind of regulatory standards that when a bank is in real trouble, not just book value trouble, but real underlying economic trouble, would still be reliable for preventing the bank from getting into distress. Now, you can imagine certain ways to do that are too costly. For example, suppose I said, tell a bank it can never borrow any money. It has to only have its equity, 100% equity financing of all of its loans. Not allowed to borrow. Well, if you don't make any promises, you can't break them, right? So if you don't ever borrow anything, you're never going to go bust. Sounds like a good idea? Not really, because, if you tell banks they can't borrow, or even if you tell them you can only borrow 50%, that would lead to a huge shrinkage of what risks they could undertake. So it's not a practical way to say we'll eliminate or grossly restrict in an unreasonable sense of the word the ability of banks to borrow. We do want to restrict their leveraging, but we don't want to just make it like zero or or ridiculously small. Is there a way, though, to come up with a robust criterion? And that's what this proposal that you quoted is. So first of all, let's look at my proposal. Holding cash. The thing that's great about cash is, if it's held at the central bank, where we're continually monitoring it, we know you've actually got the cash. It's not fraud. And cash doesn't change value. So the great thing about cash as an asset, especially if it's held by a fiduciary, is that we know that that asset value can't change. It has a very credible effect on your robustness. And it also has some interesting incentive properties. The more cash you have, the less incentives you have to undertake unseen risks in your risky assets, the non-cash assets. So that's actually a pretty helpful thing it's observable. It can be posted in a fiduciary like a central bank, continuously monitored. It doesn't change value. And it's there when the bank gets into trouble to draw on. Pretty good. Well, now you mentioned the convertible subordinated debt, or COCO proposal. That's a little harder to explain, but it's actually pretty simple. Let me start by telling you what one bank chairman, what his reaction was when I was presenting this in public. He said, "You're putting an electric fence behind me. As I'm like going backward, I'm going to go into the electric fence." And I said, "You have completely understood this proposal. You've perfectly got it." Because what did I just do? What I said is, well, it's not going to kill him, right? It's not that kind of electric fence. The idea is that if the bank experiences loss measured through a moving average of its stock price over, let's say, 3 or 4 months, it's telling us that the bank has experienced a very large loss. Then the bank has to have this convertible debt in place that it converts into equity on a dilutive basis. And that's the electric fence part, because then the CEO will get fired. So what that does is if it's large enough, it stabilizes the bank and prevents the bank from the losses from leading to default, because it converts automatically some debt back into equity on a dilutive basis. So that dilutive basis makes sure that the CEO gets fired, because the existing shareholders are going to be mad that he let it get to happen. And the way that's constructed is it creates, because of a long-term moving average, if the CEO starts to see that they're getting even close to the trigger, he can stop it hitting the trigger by just going into the market and raising new equity. And this is not the kind of COCOs that are being used by regulators. They are what are called bail-in COCOs, where when the bank's in really weak shape, then you get this conversion. That's not what I'm talking about. I'm talking about the bank's is still in really good shape. Like this conversion might happen at something like 10 or 12% market value of equity relative to market value of assets. It might happen long before you get anywhere close to the default trigger, where you've exhausted the value of your assets. And by doing it, what we do is we keep the bank away from the default state, because the CEO has very strong incentives to issue equity to make sure that the bank is robust. Back in 2008, I had breakfast with he'll remain nameless, a vice chairman of a large investment bank, just the two of us. And I said, "Hey, this was, I guess it was in June of 2008. Things were kind of calm in June 2008. You'd had the failure of Bear Stearns in March 2008. And bank equity values were all in the tank, as people understood that the other banks also had similar losses that they weren't fully recognizing and that they weren't reacting to in terms of raising new equity to bolster their position." And so what he said to me was, he said, "Well, Bear Stearns got bailed out. I don't want to, if I announce a stock issue now, it'll be dilutive. People will see it as a bad sign and my stock price will fall. And I don't want my stock price to fall. So notice, he was consciously gambling that because he was a stock investor and in his own company, he thought, well, yeah, probably this will pass. He was wrong about that. Probably this will pass. And then I won't have to issue new equity and dilute myself. So if that was really, that conversation had a huge effect on me because I realized this guy knew his bank was weak. The regulatory standards didn't require him to do anything about it. And he just decided that to hell with the fact that maybe the banking system is weak and the taxpayers might have to pay for another bailout. He's personally a little bit better off if he just rolls the dice. That was a real conversation. That actually happened. And that made me think, well, what would be a supervisory intervention that would proactively work to make this fellow decide to go into the equity market? And the answer is, if he doesn't go into the equity market, a forced conversion that's even more dilutive than what he's worried about, the dilutive effect of making the announcement of raising new equity. And so that was where the proposal that Richard Herring and I came up with, it's not that different from what Mark Flannery's been arguing. I think that many academics have argued this is a much better solution. So let me just summarize for you. Instead of telling a fib, making up a story about living wills or some other like concoction of how, when we get to it next time, we'll decide differently about too big to fail. No. Instead, you say, we'll decide exactly the same thing we just did. And so the only thing that's going to work is I'm going to prevent us from getting into that state by creating some kind of automatic stabilizer that when I get even close on a market value basis, like even 10, 12%, that's low enough that I trigger a major increase of conversion of debt to equity that pushes that bank into a very strong solvency position. That argument, I think, is a really very good one. And it argues for a kind of convertible subordinated debt that the world has never required banks to issue. And it's also using a market-based trigger, saying that when the bank stock falls, that's telling you something. If you had looked in 2007, 2008, you would see Citibank in the spring of 2007 had about a 13% market value of equity to asset ratio. But by the time you got to September 2008, it was almost zero. But that didn't happen overnight. That happened over the period of that whole period. It was a gradual decline. And what that shows is that the supervisors they were tracking that. They knew what was going on. They just didn't react to it because the book values weren't changing, but the market value was. So those were the insights I had from the crisis in 2008 that told me we could use new, more robust measures to create both better regulatory standards using the convertible subordinated debt, and also a supervisory dashboard where when we see certain things happening, we react to them, even before the regulatory standards are triggered. Did that make sense?
Yeah. And how do you think you can have good ideas implemented despite strong lobbies or politics against them?
You have to have a window of opportunity. So, for example, in Brazil, it was the hyperinflation and the crisis of the 1980s and early 1990s that created the opportunity for Cardoso. In Mexico, when it got rid of its crony banking system in 1996, 97, it was because the banking crisis there had caused such disrepute. So crises are often things that lead people to make changes. But you know, in the US, in spite of the fact that the global financial crisis of 2008 had such a big effect on our economy and the global economy, you know, the bailout cost as a fraction of GDP was not that great. And there was a perception that it was unjust. People were angry about it, but that anger subsided. Now, if you were looking at smaller countries like Chile or Mexico, when their financial system hit, the bailout cost was in excess of 20% of GDP, whereas in US it was a number like 2 or 3%. That's not trivial. It's pretty large, but it's nothing like 20, 30. In Indonesia, more than 60% of GDP. So if you're in an economy where that happens, it bankrupts the middle class because it adds to the government debt ratio just for purposes of bailing out the bank. Such a huge amount. It tends to be associated with a very deep potential crisis of the exchange rate and inflation because it puts such a fiscal burden on the taxpayers. So what I'm trying to say is that you have to have a window of opportunity where people are sufficiently awakened from their slumbers. And if they're not, the politics is just not going to change. And I don't have a magic wand where I come up with a good idea and politics becomes irrelevant. Right now, your generation has been standing by and watching your futures being stolen by my generation. We have been overspending for decades, and we finally have gotten to a point where the debt to GDP ratio is at the unsustainable point. We have about $100 trillion of unfunded deficits that we've promised, estimated in present value for Social Security and Medicare. There is no way that those payments are going to be occurring in an orderly way without some kind of either default by the government, which is very unlikely. The more likely thing is an inflation. How big an inflation? I've written about this. Let's say if we expand the inflation tax base by trashing the banking system, imposing zero interest reserve requirements on banks, maybe it'll only be like 10 or 12% a year. And if we don't do that, more than 30% a year. So your generation is, what's likely to happen is when that time bomb finally goes off, there's going to be probably a rolling back of expenditures for the safety net, as well as a taxation of the safety net, particularly for high income earners. But my point is, that should have happened, that adjustment should have happened 20 or 30 years ago. There hasn't been any big surprise. It's just that we're watching the slow-moving train wreck. Did you ever see the movie A Fish Called Wanda?
Oh, no.
You should watch it. It's very funny.
Okay.
I'm giving you a good recommendation here. In the movie, there's a guy who's standing there screaming because he's about to be run over by a bulldozer. But the bulldozer is moving at like 1 mile per hour. And so it's like, well, just get out of the way of the bulldozer. Well, he's stuck in the mud or something. But the point is, that's the way the Social Security, Medicare stealing from your generation has been operating. We all can do the arithmetic. We know it's happening, but we do nothing about it. Nikki Haley was a candidate for the presidency on the Republican side, the primaries. She was the only one talking about this. It wasn't popular. The AARP, which I would never join as an older person, is an organization that's bent on selfishness. It tries to convince itself that all the benefits that are currently promised to its members are just a matter of social justice, which is very hard to defend, I would say. And that, therefore, when they tell their members, we're out to protect your interests, nobody really thinks, well, is this really good for my children and grandchildren? Is this belonging to this organization a good idea? Is this moral? Should I be doing this? And the answer to all those questions is no, you shouldn't be. But people have a way of believing what's convenient. That in psychology, that principle is called the principle of cognitive dissonance. Trust me, it's the most important idea in all of social science. And so these political coalitions are very self-serving, and even if they are decent people, they're in the grips of cognitive dissonance and they're fooling themselves. And so our country is like about to go off the fiscal cliff with a huge inflation and a disruption. And ultimately, one way or another, I think that your generation is going to pay a hugely disproportional cost because my generation has pretended that there's no problem. Now, I just want to emphasize, politics isn't just like some additional thing to think about. It is what defines the equilibrium that determines whether ideas can matter. Ideas are necessary but not sufficient. And political constraints are absolutely crucial. And unfortunately, what I have found is coalitions often don't get reformed unless there's a major crisis. Seeing the obvious arithmetic is not enough. There's a professor, a friend of mine, Larry Kotlikoff, who's a professor of economics at Boston University. He's constructed a methodology for recasting government accounts so that you can see the intergenerational consequences of spending and taxes, so that you can see how your generation in the government spending, how transfers are happening from your generation to my generation, program by program. It's a great idea. He has been producing those kinds of ideas for decades. How many of your classmates are familiar with it? Why don't you do a poll? I think you're going to find not too many. So people like me are wondering, why aren't people like you out there in the streets with torches and pitchforks demanding that you stop having your future stolen by fat cat old people like me? I just, I'm not trying to say that we shouldn't help people who are indigent, and we shouldn't provide ways for poor people to get assistance. But look, there are a lot of people like me who, we have to pay a fee to access Medicare. We get taxed on our Social Security benefits, but typical old person is getting a lot more out of those systems than he contributed. And that includes even high-income older people. And so, it's very hard to justify it. And the reason I'm telling you this is because I just want to make a convincing argument that being able to see something as simple as arithmetic, as simple as intergenerational transfer or stealing from young people, having a professor who devoted his life, Larry Kotlikoff, to trying to measure it. He also he ran for president too, by the way. That was a few years ago. He wanted to create a third political party dedicated to financial realism and financial fairness intergenerationally that would try to solve problems that economists have identified. He hasn't succeeded. So I'm not trying to make you cynical. There are great models out there of people who've made a difference by being principled and being dedicated to ideas. The late Charlie Kirk, I think, is one of them. I'm an admirer of his. I think that people should, before parroting some kind of insulting statements about him, they should actually look into what he said. He was not a hater. He was a courageous person. And he did make a difference. So I don't want to say that you can't make a difference. But what I've learned as an economist and an advocate of policy changes, you have to choose your moment when there's a window of opportunity. And usually that's coming from, or often coming from, really bad events that shake people up. But apart from that, the bad political equilibrium is very stable.
Mhm. And looking toward the future, what do you think, where do you think the US is heading in relation to other countries, not just domestically, in the future?
Well, the whole developed world, putting aside a few examples, like Canada's in much better financial shape than we are in terms of government debt to GDP. But the whole developed world over the past 100 years has been playing a game of enacting a safety net, a social welfare system that it's making the future pay for. And that the cumulative effect is creating debt to GDP that's not sustainable. And so whether you're in Japan or in Western Europe or the US, it's a similar problem. So I see the US as still a global leader, but that's from very weak comparisons in terms of economics. I'm very worried about the fiscal cliff. I think that's a problem from, let's say, 3 to 5 or 6 years from now, that we're going to hit that wall. Not distant future. You will remember, and you'll see when it hits. The bond vigilantes will wake up, and it'll be a little bit like a grizzly bear waking up next to you, because when interest rates soar and people start to worry about the fact that there's not an insufficient demand for government debt because government debt's gotten to be too big. No one wants to buy government debt. Then you're going to see interest rates soar. You're going to see inflation as the Fed fills the gap by buying up the government debt, causing inflation to take place. You're going to see that people are going to be very concerned about it. Similarly, even before then, there's a commercial real estate overhang problem that hasn't been addressed, and that commercial real estate losses are affecting the banking system. There are about 600 banks that are insolvent. So we've got some serious short-term problems, and the tariff policies are going to probably lead to, notwithstanding the positive aspects of the Trump administration's policies, which have been deregulation and tax cuts, which are having a positive effect on the economy. Unfortunately, the tariffs will have a negative effect. I would say roughly, and this is a conservative estimate, about a negative 2% of GDP effect, which is a fairly standard kind of recession, fairly severe recession. So, of course, we have offsetting positive things, but my overall judgment is that we are likely to enter a recession by the end of this year, beginning of next year. So when you ask me, where's American leadership? Well, I don't think the tariffs have been a sterling example of leadership. We should have been working with our allies to isolate our adversaries, and using tariffs for that tool is fine. But applying across-the-board tariff measures as a way to try to promote growth in the U.S. or raise revenue is not going to work. It's probably unconstitutional, too, and the courts will probably throw it out. But if they don't throw it out, it's not going to have a positive effect. So you're looking at a very fragile situation of commercial real estate problems and 600 banks that are insolvent, negative pressure on the economy that's already showing its effects. I think leads to a recession by around the end of this year, putting us into fairly dire straits for our banking system and commercial real estate. And then within 3 or 4 or 5 years from then, the recession certainly will hasten the inevitable fiscal problem, which we're not doing anything about. And, we purposely decided not to support, we as a country, not to support Nikki Haley's candidacy. And what people learned from that was politicians don't get rewarded from pointing to big problems that require unpopular expenditure cuts or tax increases or some combination of them. So I think we're in for a very bumpy ride until voters become a little less selfish and myopic, and the bond vigilantes wake up and present the reality of very high interest rates. That's not the way people are talking right now. They're very excited about believing that the economy is in a boom phase. Some people believe that. Again, I am. By the way, I'm not one of these like partisan haters of the Trump administration. Not at all. I think that they've done a lot of good things. I think that they've done some bad things. That's the way I think most economists would look at most presidents fairly dispassionately, and they can identify good things and bad things. The problem for me, though, is that there's so little economic literacy in the population that people don't really know who to trust. And so they're hearing, President Trump is a charismatic figure. He's saying things that he, of course, thinks America's dream heyday is beginning. I'm sorry. I wish that were true.
So considering that, do you like gold or cryptocurrencies, things like that?
Yes. I wish I had bought gold a couple of years ago. It's gone up, I don't know, since I was thinking about it, about 50%. I don't know, maybe that horse is out of the barn now for a while. Maybe it's now pretty inflated. It's hard to say. I'm not a big believer in Bitcoin. I think Bitcoin's long-term value is zero, because all the things that you can use Bitcoin to do, you can use other kinds of crypto assets better. I don't think Bitcoin has long-term staying power. Models that allow us to understand how Bitcoin got to be valuable also imply that it will soon eventually not be valuable. So I know that's not a fashionable thing to say in the crypto sphere, but I believe the logic that tells me that. I'm a big enthusiast of stablecoins. I think that stablecoins will transform our payment system and maybe transform our banking system more generally. I've been writing about them, and I have some fairly futuristic visions of how we can use stablecoins initially as a medium of exchange and eventually to construct a much better unit of account than the dollar for denominating all of our transactions. So, long term, I don't count America out. We've got a lot of positive technological change going on. I'm encouraged by seeing, notwithstanding all the negative things that you see about social media and partisan fragmentation of our society and all the rest of it, I'm optimistic. I see young people like you, and I see a good future. But it's going to be a bumpy ride because people, generally speaking, aren't very aware of these risks that we're facing, these headwinds. And so they're not rewarding politicians who are trying to bring them up to get them fixed. So that's what's got to change. And I'll make a bold prediction that, just to be very conservative in my predicting, that a decade from now, those problems will not still be unaddressed. There will be, the fiscal cliff will have been hit by then. The problems in commercial real estate will have been much more apparent in the banking system. The problems of the tariffs causing a recession will be apparent. All of those things will be revealed over a sequence of years. Some sooner, tariffs much sooner, the banking and commercial real estate problems much sooner, the fiscal problems maybe later, but it's not going to be that long. So when you have these many headwinds, try to look on the bright side, it means that people are going to be awakened because these are going to be fairly violent shocks.
So this past summer, I was working at a commercial real estate company here in Houston.
Oh, really?
So what exactly are the issues you're talking about?
Well, if you look at the price per square foot of office space in the U.S., it really hasn't recovered maybe now it's starting to almost get there. It really didn't recover to its pre-COVID levels. Other segments of the real estate market have recovered, but office space not so much. There are buildings like in Bethesda, Maryland, in downtown. There's an office building that's basically useless. Maybe the market will change. People will decide that they want to have office space aplenty once again. But at the moment, the occupancy rates are low, the rents are low, and then they can't really reconfigure it because that's very expensive in terms of construction costs and other things. So we have an underutilized set of resources called office space and retail because people are doing a lot more shopping online. So COVID hastened long-term changes that we're seeing people working from home. Look, we're having this interview not face-to-face, but by Zoom. And we're seeing not only people are working by home, but they're shopping from home too. That's pretty permanent change. I mean, maybe we'll see some back and forth on it. Maybe it will recover a little bit, but they're pretty permanent changes. And so I think that the MSCI, if I'm not mistaken, in April estimated that something like 14% of the office buildings' debts that are maturing this year are going to be in properties where the face value of the debt will be greater than the market value of the building.
Mm-hmm.
Do you understand? Mm-hmm. That means that the building can't support that debt.
Yeah.
So that's a pretty big problem. That's a large number. Here we are in October. The world hasn't fallen apart yet. We're starting to see a little bit of recovery in some prices, in some markets for office space, even in New York. And so I'm hopeful, maybe that'll happen. But I'm just saying, when you look at the data, we haven't recovered very much. I was starting looking at those in 2020 when I was at the OCC as chief economist, because we knew the banking system's exposure to this commercial real estate. For most banks, put aside the top 3 or 4, most banks, their loan portfolio is 75% real estate collateralized. And for the bigger banks, it's more like half. That's a very large amount of real estate lending. So I just want to emphasize, we have a business cycle that's kind of a housing cycle. We have commercial real estate that feeds into residential real estate. We have a banking system that's deeply exposed to that risk. And those are, maybe things will get better, but at the moment, it feels like we're heading into a recession. Doesn't feel like we're heading into a boom. So I wish I could be more positive, but that's the way I see it.
So something I've personally observed, and I spoke with a professor about this last week, is there seemed to be a large disconnect between how the stock market moves and what's happening in reality. Have you observed a similar thing, and what's your reasoning as an expert?
Well, people disagree about the stock market. I mean, the stock market is an aggregator of belief. The stock price is the result of the aggregation. There are just as many people on one side as the other by construction. So, yes, it seems a bit pricey to me. I have substantially reduced my exposure to the equity market. At the same time, I have heard people talking about the role that AI will play in long-term growth. By the way, I find that quite plausible. So that you can see a long-term growth story that will affect all companies, because AI is transformative of expenses, reducing expenses across the board. And so a further complicating factor is some people believe that interest rates long-term, real interest rates, are low. We just had a recent appointment to the Federal Reserve Board, one of Trump's cronies, Dr. Miran, who says that he thinks interest rates long term are going to all be, real interest rates are going to be much, much lower. He presented no analysis of that, but just said it because it was a convenient thing to say if you're pushing for cutting Fed interest rates. If interest rates instead, real interest rates go up, and that's what I'm expecting, then that actually means that that's will be another negative influence on stock prices. So currently the stock market's reflecting beliefs that the long-term real interest rate is lower than its historical average. Maybe that makes sense. We did see a decline in real interest rates during the 1990s and the 2000s and the 2010s, 2020s. We've seen a 40-year secular decline in real interest rates globally, not just in the US. But I think that started to reverse in the last 5 years, and I think that we're now looking at a very different outcome. And if that happens, that's another reason to be worried that the stock market's a little overpriced. But I don't claim to be able to weigh in on, how overpriced the stock market is, because it's a very hard thing to do. It requires you to have a lot of confidence in your growth of earnings forecasts. I don't have a lot of confidence in mine because I think we're at a time of extreme uncertainty about long-term growth and positive uncertainty coming from AI. So it's hard to say. I wish I could give you more of a concrete view there, one way or the other. The market aggregation tells us that the current price is the best guess. So who am I to question the stock market aggregation?
Mm-hmm. And lastly, we ask all of our interviewees the same question, and that's, how do you define success, both personally and professionally?
Oh, I think what we feel, the word success, when we force ourselves to look in the mirror. The only person, I was very glad that my parents were proud of. I knew they were. They're both passed away long now, but I knew they were proud of me. That mattered a lot to me at the time. But that doesn't work. That's not enough, right? That's not enough. I made a good salary. Okay. That's nice. That's not bad. I published a lot of articles. I have a huge number of citations. Look me up in Google Scholar and you'll see I've got a large number. I've got a great H score. That's, everybody likes talking about H scores. Okay, those are all great. I don't think about that very much. That doesn't make me feel good when I look in the mirror. What makes me feel good when I look in the mirror is that I'm making progress, first of all, with my own personal quests for truth and beauty in economic research and in music. That's what success is. And the harder one is interpersonal relationships, feeling like I'm doing all that I should be doing to maintain those interpersonal relationships. Those are the things, for me anyway, when I look in the mirror, I say, am I really doing all I can with those personal relationships? And I'm pretty sure I'm not. It's probably not my strong suit. And, I'd like to know more how to do better on that. So that's what success is. When you really look in the mirror, I'm a religious person. I believe, very much believe that I have a personal relationship with God. And I'm pretty sure I'll be surprised by what God's view of success is, and maybe not in a positive way. So, yeah, I don't think we don't stand around gawking at ourselves in the mirror feeling, at least I don't, feeling chuffed with my success. I feel it's more like glad to be here, glad to get closer to truth and beauty, and hope that the people I love or that surround me, that I can have good relationships with them. And of course, I understand I need to eat and have a place to live, but I don't, beyond that, I don't really get um, how having more square footage of house space or more jewels or any of that makes you feel great. I don't understand that.
So I know I said that was the last question, but just to go onto your music, do you do sort of like digital things? Um,
Let me tell you what I do. Here, I happen to have these. I wasn't thinking. So here are the albums I've published with Da Vinci Classics.
mhm,
This is the most recent album. I have another album coming out this month.
mhm,
Um, and this is classical music. This one is called Evlogia, which
mhm.
means blessings in Greek. So it's a kind of Greek influenced classical ensembles. You can find all of the stuff, my blog, lots of fun videos, some music samples at something called panohoraensemble.com. That's spelled one word, Panohora, then the word ensemble, ENSEMBLE.com. Panohoraensemble.com. Go there, check out my blog, check out some of my compositions. And we have a new album coming out this month from Da Vinci Classics called Gethsemane, which is about my imagination about what it's like for Jesus in the last hour in the Garden of Gethsemane before he's seized.
Mm.
So that will be part of a double world premiere, that and another piece, which are going to be performed in New York City in Merkin Hall on March 20th and 21st. And I expect you to be there.
I'll be there. But so like when you go to produce, so I used to play the piano years ago.
Huh?
But
Don't give it up.
I know, and I have friends who play instruments, and there's a band at my school and whatnot. So when you go to produce a song about how Jesus felt in his last moments, how do you go about that, and how does that sort of come to
You know
be?
what I love about talking with you? It's really fun. Is that you ask me so many substantive questions, which I really enjoy. And one of the things I would just advise you and all your listeners: just because you get older, don't stop doing that. Nobody, people in their 30s and 40s and 50s and 60s, in my experience, don't stop asking such interesting, probing, substantive questions. At least they do so less frequently. So just put a little note to self.
Mm.
Keep asking good questions. Okay, so it's very hard to explain, and I've heard other composers try to do it, how you write music. Of course, there are things you can do mechanically to try to make something start in your writing. But the word inspiration means that something's coming in that's in the spirit. That's what the word is derived from. You get inspired. Things happen that are sort of beyond our intellect and beyond our mental understanding. And so I actually think there's an element of miracle to every even reasonably good composition, that there's a kind of miraculous aspect to it of tapping into that, what I would call the truth of a musical phrase. Because musical phrases, if I just kind of randomly generated something, it wouldn't be pleasant. There's a truth to what's going on. That doesn't mean everything's equal, but or that all things that are okay are the same. They're not. But so I don't know how to answer it. I find that you just have to kind of open yourself. You just have to say, what can I think about? And then if you open yourself, somehow you get inspired, spirit coming in. I think it's a mystical thing. By the way, Paul McCartney said the same thing when he was asked, how do you write music? He kind of said it's kind of mystical. But there are things you can do sitting down with an instrument that kind of prod it, like just playing an interval or playing a chord and letting that prod your imagination. And I know McCartney does that too, by the way. So, it's kind of hard to describe how you do it. But when you get a musical idea, what I can tell you is once you have the first little grain of it, then you tap into the truth. That is like, what does that idea want to be? What is that idea? Where's that taking me? I'm not saying there's only one way to go with it, but I'm saying that there's a finite number of ways to go with it that make sense, that are musically true. And so, a lot of this is you have to reflect on sound to see whether you find it valid. And so, you try. It's trial and error too for me. I'm not Paul McCartney. He's they call him the Mozart of pop for a reason. The guy's just amazing. But you have to reflect on the idea and where it might go, and then you try something, and then you listen to it and say, no, that's not it. That's not it. And then that's it, right? And then now where does it go from there? And then before you know, you're done. Mm-hmm. So that's the best I can do to explain it. There are little tricks like I've learned from others about the idiomatic elements of each instrument. So certain instruments, there's certain kinds of sounds that you make in each instrument. You don't just write music that can be played on any instrument. The flute and the guitar, they're not the same. You write different music for them. Also, there are little tricks, like little rhythmic figures or other things that make it spicy, that make you wake up as a listener. So you don't just kind of march your music in this kind of boring drone-like way. You have to try to use little effects that are helpful. So there are little tricks of the trade, but that's more like things that you do that kind of pop out, because once you've written something, then you kind of say, oh well, this is kind of boring in here. What can I pull up out of my sleeve to make this a little bit more interesting? But that's after you've already got the basics of all the elements of harmony, melody, and rhythm.